goes longer than a minute.
All right, guys. Hello. Oh, it's a bad hair day for me. Jesus. Anyways, hello, guys. Welcome to another masterclass with 7 Ways to Wealth. Thank you so much for being here. I'm super, super, super duper excited to host another masterclass for you guys. So tonight we have a lot planned for you. Our expert, our go-to person when it comes to trust taxes, our CPA. Jeff Badu is in the building, you guys. So Jeff Badu is the founder of Badu Tax Services. And so tonight he is going to be educating you guys. So some of you guys are familiar with him, some of you guys are not. So he is brand new to you and you are going to be brand new to him. But like I said, he's the founder of Badu Tax Services and he is the go-to person when it comes to doing your taxes and saving a lot of money on taxes for your businesses and as well as your trust. Okay, so he's going to be educating us on the 1041 form tonight. I'm super excited that he decided to come on and train you guys on this important tax form, okay? Especially because it is the season. So without further ado, I do want to invite Jeff up. So Jeff, thank you so much for coming tonight and for educating the community, the wealthy trustees. So you have the floor, Jeff.
Absolutely. Thank you, Christina. Definitely appreciate the time today. Appreciate you for inviting me to speak to, you beautiful people today. And yeah, definitely appreciate everybody for joining. One thing about my presentations is I do like to keep them relatively short, nothing too intense, nothing like that, just because I understand that the topic that we're talking about today is highly, highly complex, right? Even some tax professionals don't fully understand what we're going to be talking about today as it relates to trust taxes. And so with that being said, first and foremost, do want to recognize Ghana, the nation of Ghana. We're celebrating our 68th Independence Day today. So happy Independence Day to the nation of Ghana. And that's why you see this suit jacket, with the African material and everything like that. So shout out to the nation of Ghana. If you haven't had the chance to visit the country of Ghana before, I strongly encourage you to do so. Ghana is always growing, has a lot of riches, a lot of natural resources, a lot of tourist attractions and everything like that. And so Ghana is a great place to visit as a nice destination. And so once again, happy Independence Day to the nation of Ghana. And, we're celebrating all day today in style. All right. And so let me just go into the intro slide really quick. And so for those who don't know who I am, my name is Jeff Badu. I'm a licensed certified public accountant. I was born and raised in Ghana, came to the US when I was 8 years old. And fast forward, I attended the University of Illinois Urbana-Champaign, where I received my bachelor's degree in accounting as well as my master's degree in accounting. I'm a parallel entrepreneur and a wealth multiplier. I'm the founder and CEO of Badu Enterprise LLC, which is a multinational conglomerate in the finance industry. And what we do is we provide a suite of financial services, including our marquee company, the main company who's presenting to you all tonight. And that is Badu Tax Services LLC. And that is a CPA firm, a tax firm that provides tax preparation, tax planning, and tax representation services to individuals and businesses across all 50 states in the US. And we also have clients that are physically based in over 25 countries at the moment. We also have Badu Investments LLC, which is our real estate investment company. And then last but not least, why we're really here today is financial literacy, right? To get educated on the topic of wealth, on the topic of taxes. And that's what we have the Badu Foundation, where we teach financial literacy across the country, whether it be the youth, the elderly, the adults, right? Anybody in general, we can teach financial literacy to. I personally host over 100 workshops across the country, or across the world, actually, each year. And lastly, my purpose in life is to inspire and support the super hungry to take hold of infinite resources in order to create an abundant lifestyle. All right. For those who didn't catch that, maybe you're in transition, maybe you're getting ready for, you're making dinner, whatever the case may be. Let me just repeat it one more time. My purpose in life is to inspire and support the super hungry including the 85 plus of us so far tonight who are volunteering our precious time to take hold of infinite resources, such as what God has manifested in me to deliver to you all tonight, in order to create an abundant, not scarcity, but an abundant lifestyle. With that being said, today we're going to talk about trust tax returns. We're actually going to look at a trust tax return. We're going to go from top all the way to the bottom, the 1041 trust tax return. And a few things to note. If you have any questions, please feel free to type them in the chat. If you have any questions or contributions, please feel free to type them in the chat. I promise we'll say at least 30 minutes today for Q&A. I understand this is a very complex topic that we're talking about today, a very complex matter. And so I'll keep it pretty short, right? I'll hit the main points. I'll hit the important things that you need to know, and we will look at the tax return together. But nonetheless, I do want to make sure that, basically we have a lot of time for Q&A. So if you have any questions, please feel free to type them in the chat throughout the presentation. And I'll also share my contact information in the chat as well. And then at the end, I'll share with you a QR code that you can scan. Please let us know that Christine Yvette or Seven Ways to Wealth sent you so that we can properly give the credit to the right individual. And so with that being said, let me just go ahead. Let me pop this in real quick, and then we'll look at the form here in a bit. So here we go. And hopefully everybody's having a great evening tonight so far. And let me just put this here in the chat for everybody so that you have it. And so, so basically when we talk about trust taxes, it doesn't really get any more complicated than this, in that the 1041 income tax return is probably the most complex tax return there is. In my opinion, it can't really get any more complex than this, in that if you can get some of the takeaways today and you understand what we're talking about today, you're very well on your way to that wealth creation, that wealth building journey. Now, let me just give you a little bit of history behind this form. Now, I do understand that, a lot of you or all of you basically work with Christina. You're setting up your trust, you're getting educated when it comes to trust. So I'm not going to go into the details of what a trust is and what it's not and all that stuff. But I do want to make sure you understand the purpose of the trust and the trust tax return, right? And so the thing about the US, the United States of America, land of the free, home of the brave, is that there's two major tax forms. There's a 1040, which is for individuals, right? Everybody has to file a 1040. That is for an individual income tax return, your personal tax return, whether you're married or you're filing single. But then they did you one better. The 1041. The 1041 historically has been used by the rich and the wealthy, for lack of a better term. And the Elon Musk, the Jeff Bezos, the Warren Buffetts of the world, they're the ones that historically were using these forms. But thanks to Christina and the Seven Ways to Wealth team, we're now being more educated when it comes to trust. Now we can become part of the quote unquote 1%. In that, yes, this form is complex. I never advise you to try this at home. You do want to utilize a tax professional that is comfortable with this form. And I can tell you this, over 90% of tax professionals are not comfortable with this form. Let me repeat it one more time. Over 90% of tax professionals are not comfortable with this tax form right here because it is very complex. Now, there's ways to simplify this form, but it could get pretty complex, right? As you can see in box A, for example, like which box do you actually check? Do you check the grantor type trust? Do you check the complex trust, the simple trust, the seasons estate? Which box do you check? That alone can be complex in itself. Now, luckily, thanks to tax forms, they do give you instructions, which you can read through and spend the necessary time. It's like when your sink gets clogged up, you can go on YouTube, you can read all about how to fix a sink, but you might be saving that time and energy and resource by investing it elsewhere and instead utilizing a tax professional who understands these forms to assist you and properly fill out and complete this form for you. All right, so the 1041 historically was available only to the ultra wealthy. Those were the only folks that were utilizing utilizing it because all of their assets were owned by a trust, right? Now, let's just go back to the beginning. I did say that I don't want to go into the full details around trust and the history and all that, but it is important to know when we fill out a form, why are we filling out the form, right? Why in the world are we filling out the form? So basically, when it comes to a trust, one of the main purposes of a trust is to pass down wealth from generation to generation. All right, that is one of the purposes. And then it can also help you save money on taxes. Right? There's some tremendous benefits, tax benefits when it comes to a trust. For example, you can literally pay $0 in income taxes by structuring your trust correctly and filling out the forms the right way, the correct way. So two real main things when you see, so this form, by the way, is also used for estates and trusts. When somebody passes away, God forbid, their dead body all of a sudden, or them as a dead person, becomes a living entity. Let me repeat it one more time. When somebody passes away, them as a dead person, their physical being we know is gone, it's dead, but they become a living entity, meaning a business with a tax ID number called an estate gets created upon somebody's death, right? So that's one of the purposes of this form. And then what we're talking about today is a trust, right? A trust. Now, two major types of trusts. There's a bunch of sub trusts under those major ones as well, but there's a revocable trust and then there's an irrevocable trust. A revocable trust, you don't need to file a tax return for. Let me repeat it one more time. A revocable trust, you do not need to file a tax return for, right? Because it's considered a disregarded entity for tax purposes. What is a revocable trust? It is a living trust, for example. It is the most common trust in the world, a revocable living trust. The purpose of this is to have assets and wealth passed down from generation to generation without going through the annoying and expensive court process known as probate. Right. Rest in peace to Prince. Rest in peace to Aretha Franklin. Rest in peace to even Pablo Picasso. But unfortunately, none of them died without a will. None of them basically had a will, nor did they have a trust when they passed away. And so what happened is that all of their assets basically went to the court, and the court determined who can actually get these assets. You had people coming after Prince for unclaimed child support when it wasn't really even his kids. Just a bunch of nasty stuff going on. And so you want to make sure you have basically, when it comes to wealth transfer, you do want to make sure you have a trust. So we have a revocable trust and then we have an irrevocable trust. Now, irrevocable trust is a lot more complex than a revocable trust. The purpose of an irrevocable trust is that you can't really change the beneficiaries. You can't really change a lot of things with that trust, nor does that trust ever really end. It's pretty much an entity that basically lives on forever, right? So we have revocable, which means that you can usually change the beneficiary. You can change things about it. It's a lot simpler. And then you have the irrevocable, right? Irrevocable trust, meaning that it's a lot more complex, but there's not really much you can't really change things about it, but you can certainly control it. And if your trust is structured the right way, all right? So for this tax return today, we're going to look at an irrevocable trust. And that's typically the trust structure that we have when you have, your business trust, your family trust, and then your private foundation or your ministry trust. The ministry trust does not use a 1041. Instead, it uses basically a nonprofit, a 990 form, 990 private foundation typically. And so the 1041 is really going to be applicable to your business trust and your family trust. All right. So what do these boxes actually mean? A simple trust means that you basically can all of the money that's in the trust, all of the income, the profit of the trust gets distributed basically equally each year. Like you have to distribute everything each and every year. So this would be an example of a simple trust in that whatever, let's say the trust makes $1,000, right? That $1,000 has to go to the beneficiaries through a Schedule K-1 that gets attached to the trust. So a simple trust is, right, it's very, very simple. It's not really complicated. There's not really much to it. Most of these trust tax returns that I would say would be more so of a complex trust. And this is where you can distribute according to however way you decide. And it's usually based on a trust agreement. You can say, hey, I don't want to distribute anything, right? You can say, hey, I want to do half or I want to do a quarter. And so, if properly structured, you can literally set yourself up to not pay any income taxes during the year. All right. And so, let's just go through this real quick. So, let's say this is a complex trust. And let's just say this is your business trust, right? Business trust. And the example that we're going to use today is the John Doe, right? Irrevocable business trust. So basically in the box, you're going to put the name of the trust. So the John Doe, today's example, we're going to use John Doe Irrevocable Business Trust. Now, one thing you want to do, you want to make sure you put the fiscal year, right? The actual year. So typically it's going to be a calendar year. So you don't necessarily need to fill in these boxes, right? So it's going to be a calendar year, meaning it's January 1st, 2024 through December 31st, 2024, right? And we're using the 2024 example today. All right, but for the sake of, clarity, let's just go ahead and put this in there anyway. So we're going to do January 1st, 2024 through December 31st, 2024, all right? So all trusts, let me repeat this, all trusts must have a tax ID number, whether it's revocable or irrevocable. All trusts must have a tax ID number to make it legitimate, whether it's revocable or irrevocable. Remember, today we're dealing with an irrevocable business trust. So basically, we're going to have a tax ID number. All right. And the tax ID number basically separates the trust from you as an individual. Let's talk about when the trust was created. Let's say it was created on January 1st of 2024. All right. And then the fiduciary. Now, typically what I see, basically the fiduciary or the trustee is the person who's responsible for the trust, right? Who are you entrusting the responsibility of the trust with? I've commonly seen it as a company, right? A trust company. And so we can call it trust company, right? A. So this basically is the group of people who are responsible for making sure the trust is run correctly, is run appropriately. You do have to pay a fee to your trustee. So another name for fiduciary is trustee, right? Who's the trustee of the trust? And then we'll put the address. So 123 Main Street. All right. And then let's put them in good old where I am currently, Dallas, Texas. Hopefully that's the right zip code. All right. And then let's just say this is an initial return because this is the first year of us filing the return. All right. And then let's see here. All right. So basically, so this is all the basic information of the trust. This is pretty straightforward. But one of the key things to keep in mind is ultimately these boxes right here. Which box do you check? So if it's an irrevocable trust, typically you're checking the box complex trust, right? Because you want to have control of when distributions are made and everything like that. You don't want to distribute equally throughout the year and pay taxes on the distributions. All right. So we got the name, the address, the name of the trust itself, the trustee or the fiduciary, the address of the trustee or fiduciary, the tax ID number, when the trust was created, and then ultimately, you put the dates of the tax year essentially. Now remember, a tax professional is going to do all this stuff for you. You don't have to go through all these complexities or anything like that. This is a very complex tax form that over 90% of tax professionals, accountants, CPAs do not know how to complete this form correctly. All right. And let's just say you're the only beneficiary of your trust, right? Or you may have a revocable living trust as your beneficiary. So let's keep it simple. You only have one K1. All right. So let's say your trust invests money into, let's say it gets interest income throughout the year, maybe has a bank account and it has interest income. So let's just say that your trust is earning $7,500 in interest income. All right. So we put that in box one. The very first box in the income section is interest income. How much interest income did you earn? All right. Then you have business income. Now, notice it asks you to attach a Schedule C, right? Schedule C, just like the 1040. As a matter of fact, it uses the 1040. It borrows the 1040 to complete or to attach it to this return. I can say this: if you're properly structured, then you're going to have a separate business entity that is outside of the trust, right? Let's say an LLC, where the trust owns that LLC, and now all of a sudden that LLC issues a K1 to the trust, right? The LLC issues a K1 to the
Yeah.
trust. I'm sorry, go ahead.
Okay.
Somebody have a question? Okay, looks like somebody was unmuted for a second. If we can all please mute our microphones, that would be greatly appreciated. Welcome everyone. Once again, we're going over a trust tax return today, a 1041 trust tax return. All right, so basically what I was saying is that a trust that is properly structured, usually it's not the trust itself that is doing the business. It is another business entity like an LLC that is doing the business essentially. All right. In that, if basically, let's say you have a company, let's just say you're a real estate agent, right? You have a real estate agency company. You're probably going to have a separate LLC that actually owns the agency, the real estate brokerage company. And then your trust is ultimately going to your trust is going to be listed as the owner of the real estate agency. All right. So in that case, you're going to have other income in this section. You're going to show other income because there's going to be a K1, a form called a Schedule K1 that is attached to this return. And that is ultimately going to show the income and expenses of of that LLC that you own. All right. And so this trust ideally doesn't really own anything outside of the actual business entity. That's why we call it a business trust, because it owns a business entity. So in some cases, you might not actually see any income listed here. You'll just see other income in the form of a Schedule K1. Or if you choose to run your business through the actual business trust, and you have business income, then you just attach a Schedule C, which the Schedule C is going to include the income of your business and then also the expenses of the business. All right. But we have interest income. We have any dividends that you earn, business income or loss through a Schedule C, capital gains, rents, right? And notice here, if you have a rental property that the trust owns, well, guess what? You're going to file a 1040 Schedule E and attach it, just like we do with the regular 1040 tax return. Any farmers out there, you're going to do a Schedule F, right? Your trust owns the farm. Any capital gains, anything you sold, let's say you sold stocks or you sold properties throughout the year, it's going to go under ordinary gain or loss, right? And then the infamous other, which is like any K1s, any investments that you own that is essentially not owned directly by the trust, but basically the trust serves as the beneficiary of those assets. So it receives a K1. All right. Then you have deductions, any interest that you're paying. Maybe you took out some loans on behalf of the trust. You can go ahead and mark that interest. Any taxes you paid, that's also tax deductible. Fiduciary fees that you pay to your trustee, that is going to be tax deductible. And get this, charitable deductions. So this is where you're going to put the amount of money that you transfer to your ministry trust or your private foundation trust, for example. In a perfect world, your net income, your taxable income of your business trust should be zero, right? It should be zero, because what's going to happen is money from your business trust is going to get transferred to your family trust. And your family trust is the one that pays for your personal expenses, your day-to-day, your medical bills and your mortgage and everything like that. So your business trust pays for your business expenses, things that are directly claimed as a business tax write-off. Whatever's left over, we transfer it to your family trust, all right, to pay for your day-to-day family, expenses. Then whatever's left over after that, we donate it, we move it to the charity, the private foundation trust or your ministry trust, and all of a sudden your taxable income is going to show a zero, right? This is ideal because trusts have a very, very high tax rate, in that the highest tax rate right now for a trust is 37%, and that's just at the federal level. 37%. And unlike the personal 1040s, the brackets are very, very small, right? Very, very small for a 1041. As a matter of fact, the highest bracket is only about $15,000 plus, right? That doesn't even scratch the surface of a 1040, a regular individual income tax return. All right. And so this is where you would put your charitable contributions, your charitable deductions, fees that you pay to your attorneys, your accountants, your return preparer fees. That goes here in box 14. And then an infamous other deductions, anything, any other investment deductions and everything like that, that goes there. Any carryover, what we call net operating losses, anything that's carried over from year to year, that's going to go in the 15B. And then there's going to be the income distribution deduction, right? And then the estate, this is for estates, right? The estate tax deduction. And so pretty much any money, here's how a trust pays taxes. Any money that's left over that you keep in the trust is going to pay a tax of most likely 37%. You leave $1,000 in that trust, you're going to pay $370, right? $370, 37%. However, if you give the money to your beneficiaries, quote unquote, in the form of a distribution, then your beneficiaries via K-1 form are the ones that are going to be paying the taxes under 1040. A K-1 is you basically a company passing the tax bill to an individual, right? A human being, an individual like yourself. And so any money that is shown on a K-1 means you have to pay the taxes at your ordinary income tax rate, right? So it's almost like when you have a trust, it's almost like playing hot potato a little bit. You do not want any number in this taxable income section because it's going to incur most likely a 37% tax bill. So if you don't do this correctly, and this is why I say don't try this at home, but if you don't do this correctly, if you don't structure it correctly, if you don't have the right professionals involved, and let's say your trust made $100,000, well, you can get a tax bill of $37,000 unnecessarily when you could have passed that money to your 1040, which would have had maybe a 20% tax rate instead of a 37% tax rate. The money could have been sent to your family trust. It could have been sent to your private foundation or your ministry trust. So you really want to be extremely careful, and it is very important to move the money the right way in the right time. All this stuff usually has to be done before, right? Before the year ends. If that money is left in that trust account, it can be some trouble for you when it comes to taxes. By the way, every irrevocable trust must, I repeat, must file a tax return each year, even if it has zero income. Even if it has zero income or zero profit, all irrevocable, all complex trusts must file a tax return every single year, the 1041 income tax return. All right. And the due date for this return is April 15th every year. April 15th. So we have a due date coming up in a little over a month here. All right. And so we have the income, then we have the deductions, and then what's left is your taxable income. And that's your income minus your deductions. The total tax is most likely going to be 37%, right? 37% times the taxable income. And that's how much tax that you pay. All right. And then you put any estimated tax payments that you made, with total payments. Um, and you could get a refund, right? You could get a refund from your trust if you overpaid any taxes. A tax refund is usually simply money that you overpaid to the government and are refunding the money back to you. All right. You sign a date here if you filed this yourself. And get this, they want to know who the fiduciary is too, right? If it is a financial institution. And so if it's a financial institution, they want to make sure they know the tax ID number. And then if you have a preparer, you want to put all that information here. Then you'll notice that there's also additional schedules. So any charitable deductions, so any charitable contributions you made, that goes under Schedule A. Income distribution deduction, meaning money you gave to your beneficiaries, that goes under Schedule B. And then Schedule G is where we calculate the taxes. All right. And then there's the other information section. So as you can see, this form can either be pretty simple or it can be pretty complex. I mean, what if you have a business that has, 5 income streams, it owns 5 LLCs, it owns 3 rental properties? It can get pretty complex, right? And so you do want to make sure you work with the right professional, right? Someone who understands this form and ultimately can assist you in the best way possible as it relates to navigating between this form. I did promise here we'll have some time for some Q&A. And so let me go ahead and share my screen here, for the contact information. In case you need assistance completing your trust tax return, you need a tax professional, you want to do some tax planning, feel free to scan this QR code and it takes you to a 1 minute questionnaire, just a 1 minute questionnaire, letting us know who you are, right? Your name, your phone number, email address, what assistance you need, what forms you need assistance with, right? Just 1 minute, right? 1 to 2 minute form. And I will put the link again in the chat as well. I know some people are on their phones or mobile devices, and so I'll put this link in there as well. Our phone number is 773-819-5675. That is 773-819-5675. I will drop the link to the QR code in the chat so that you can have a clickable link as well. But if you want, you can take a picture and scan this QR code and complete a quick 1 minute questionnaire. My only ask is please let us know that Christina Yvette and or the 7 Ways to Wealth team sent you, so that we can properly send the proper thank you to Christina and the team. I know Christina works very hard. The team works very hard to put events like this together. And yeah, and this is something that we want to educate you when it comes to this. And so with that being said, I would love to open up the floor for questions. Let's open up the floor for questions. And let's take it back to Christina if you want to take us in with the Q&A segment.
Yes, thank you so much, Jeff. I appreciate you so much. That was so in-depth and thorough of you going through the 1041. And I'm so glad that the community got an opportunity to see it and to see the process of what it looks like to actually fill out that tax return for the complex irrevocable business trust. So I do want to open up the floor for Q&A. So please raise your hands. And also Jeff will be looking in the chat as well. So I'm going to pass it back to you, Jeff. I see the first person is Kima. So let's start Q&A.
All right. Thank you, Christina. It's been a while. And thank you, Jeff, for this wonderful information. I wanted to know, do you have to, if we have all 3 trusts put together, do we also have to file an individual tax returns?
That's a great question, Kima.
Yeah, I was wondering about the child income tax.
Uh-oh, there we go. Go ahead, Kim. I'm sorry.
Yeah, I was wondering about where the tax credit, the child tax credits and all that stuff fits in.
Absolutely. Absolutely. Thank you for that great question, Kima. So, the US is a place where things can get pretty complex. The tax code can get very, very complex. As a matter of fact, Albert Einstein, one of the most intelligent individuals on the planet, said the income tax is the most complex thing on the planet. The income tax is the most complex thing on the planet. And so to shortly answer your question, Kima, you do have to file a 1040. And I do understand that when we set up the trust, basically we'll list you as one of the beneficiaries of the trust, whether it be at 98.2, whether you're 2%, trust is 98%, 90-10, right? However way we decide to split it. So for your portion, for your K1, since you will have a K1 attached to your personal tax return, you do have to file a personal tax return. This lists your W-2 income, for example, which unfortunately can never go to a trust. We can never put W-2 income towards a trust. And so, and this is where you want to be extremely savvy, extremely strategizing when it comes to setting up your trust and ultimately filing the forms the right way. Because what we can do is we can structure you where if you have some W-2 income, we do want to have some of those businesses on your personal return so that you can claim losses against your W-2 income, right? Whether it be real estate, whether it be a business like an S corporation, oil and gas, that's another way. So we do want to file a 1040 individual income tax return. That's where we'll claim your dependents. That's where we'll get your standard deduction amount that everybody in the United States is entitled to. It's about, 13,000 plus. for single, and then 26,000 plus for married. So we do want to make sure that we get you all your credits and your exemptions and your deductions. So in the course of a year, you may actually end up filing your business trust. That's one. Your family trust, that's two. Your private foundation trust, that's three. All three entities, it is a must. You have to file every single year once you establish those trusts. And then you may also have to file your, and then you will also have to file your 1040 individual income tax return. So that's four tax returns right there. It can get a little pricey. It can get a little up there. But hey, we're passing down the wealth from generation to generation that can go past 1,000 plus generations that come after us. And so, yes, you do have to file your 1040 individual income tax return on top of these tax returns as well.
Okay, thank you.
Yeah, no problem. No problem at all. All right. So before we go and to the folks that had their hand raised, I knew we have a lot of commentary in the chat. Let's see here. We got some compliments. Beautiful hair. Christina, love it. Yes, indeed. Let's see here. Tosh says Happy Independence Day. Thank you, Tosh. Deborah says much love, Ghana. Tony says Happy Independence Day to the nation of Ghana. Yes, indeed. Cena says yes to Ghana. Woohoo. And yep, we got some. Yeah, we got a lot of love in the chat team. We got a lot of love. Let's see if there's any questions in the chat real quick. Any advice over an affordable tax software? I mean, if you're talking about you being a tax professional, then it is the Drake tax software. The Drake tax software is pretty, pretty affordable. If you're talking about you completing it yourself, remember, I advise do not try this at home. This is not for your TurboTax. This is not for your H&R Block, typically no knock to them, but this is complex. When somebody tells me that 90% of the people in the profession that get paid to do something don't know how to do the trust tax returns correctly, then I'm going to be pretty selective, pretty picky as to who I pick to do my trust tax return in that case. So this is definitely not something, unless you're a tax professional yourself, this is not something you really want to try on your own. You do want to utilize a professional. But if you want to take a stab at it, I'm sure there's TurboTax and H&R Block that can help you with the forms in a more affordable manner. I can tell you we do have pretty competitive rates when it comes to tax preparation. So I'm more than happy to take that conversation offline. And I did drop the links in the chat. Please let us know once again that Christina Yvette and or the 7 Ways to Wealth team sent you so that we can properly give the proper credit. Let me do one more question and then we'll go to the hand raise as well. Anita says, is there a difference between how revocable and irrevocable trusts are taxed? Yes, Anita. Revocable don't pay any taxes technically. You don't pay any income taxes because it is a disregarded entity for tax purposes. A disregarded entity for tax purposes, meaning it does not file a tax return on its own. Right? Revocable is like your living trust, your revocable living trust. It doesn't pay any taxes. All the income and expenses goes on your personal tax return, your 1040 tax return. Irrevocable, that's exactly what we just went through. You can pay up to 37% tax rate. If you structure it correctly though, you should have a 0%, $0 tax bill each and every year if it's structured correctly. And if the forms are filled out correctly, you're moving the money around correctly. All right. Let's go to Maria. Maria, please go ahead and ask your question. You can unmute yourself.
Good evening. So my question is about the personal taxes. Are we still able? So I don't have a W-2 job. I only have a 1099 independent contractor that I would like to move over to. Well, I have a LLC and I have a holding company. And I'm trying to set up my trust, but you're saying that we still get to take our same deduction. So like if we're paying our children through through our business, like our LLCs, that still can happen?
Yeah, so all that stuff can happen. It's just the name of the form that you're using that changes. That's all this really does. So there's a lot of movement, so what I always advise doing is when you do the structure, number one, you're committing to something. You're committing to something that is complex, but ultimately is going to save you a lot of money, time, and taxes down the road, right? So you want to lay out your corporate structure. You're now like Bill Gates. You're now like Warren Buffett, Jeff Bezos, all the greats of the greats. in that you have all these different entities. So you want to lay out an org chart, an organizational structure, so that you can see how the money flows, where the money flows through, and so yeah, you can still hire your kids, pay them $13,000, write it off. This goes on your business tax return, your LLC tax return, whether it's an S corporation or a C corporation, whatever the case may be. Or if the business trust is the business itself, then it goes directly on the business tax return, right? The most common thing that I've seen is a separate LLC that runs the business, the day-to-day business, and then the trust owns that business essentially. And so at the end of the day, you notice it's like solving a puzzle, right? This piece versus that piece and that piece and that piece. It's all
I
going to
think
come
you need to get out
together.
your whiteboard.
And yeah, exactly. Exactly. Yes,
I have
indeed.
one more question.
Mhm.
So with that being said, um, I think the person before me, she was heading towards that way. Do we still get like earned income credit and so on and so forth? How does that work? Do we still get a return or a refund? Knowing that there's a big difference between returns and refunds.
Mhm.
Um,
Yeah, definitely, Maria. You can get all of this. You can get your maximum earned income tax credit. You can get your earned maximum child tax credit. And you, of course, do have to show income on your 1040 in order to become eligible for these credits.
mhm.
So this is where what we can do, right? This is what we can do. If we do some tax planning throughout the year, which is a service we offer, we can do a mock tax return for you, a 2025, for example, mock scenario. We can look at all your structures, everything. You say, give me the maximum benefits, please. We can literally look down to the dollar of how much you need to show on your 1040 tax return to get your maximum earned income tax credit so that we can shift the income on that return, right? None of this is illegal, by the way. All of this is legal, right? Just paperwork. That's all it is. It's money movement. We can say this is how much your business trust needs to ensure that we have in the account. This is how much your family trust needs to have in the account. We can create a budget for the business trust, the family trust. And then whatever's left over, we transfer that money to your private foundation trust, which or your ministry trust, which you can invest that money. You can buy stocks, you can life insurance, all that stuff. And so, yes, you can get the full maximum earned income tax credit with these strategies. You can get the full maximum, child tax credit with these strategies. You can get the American Opportunity Tax Credit with these strategies. It just all depends on if we
American
are putting the
Opportunity,
money in
that's
the
for
right
like teachers
places.
and stuff, right?
I'm sorry, what was that?
The American Opportunity, that's for like teachers and stuff.
It's for someone who is an undergrad college student, right? Who
Okay,
pays
that's
tuition.
what. Okay,
Exactly. Exactly. Yes,
okay.
indeed.
All right. I'm
Absolutely.
gonna let somebody else have a question, and if you can come back to me, I appreciate it.
Sounds good, Maria. Most
All
definitely.
right.
Yeah, I think you're
Thank you.
definitely somebody who should click that link, schedule that consultation, and let's have a deeper discussion offline as well. All right. Sounds good. Let's go to Robert. Robert, please go ahead. You have your hand raised.
Yes, good evening, Jeff. How are you, sir?
Yes, sir. Doing good. Doing
Good.
good.
Thank you. And Christina, a question for this may be for you as well as Christina. Um, the tax, how is it or how can it be structured to where if you have a 98, can you put all of the trust under the 98 and eliminate everything that you've just spoke of? Or how can that be structured?
Yeah, short answer is yes, you can. Basically, that 98% of your profits or 98% of the ownership, you want to make sure that the money is moved around correctly and that whatever's left over in the business trust, my advice, invest that money, buy some real estate, buy some rental properties, buy a business, right? It's almost like a hot potato game. What can I buy? And of course, buy things that add value to your life, buy things that ultimately make you some money, right? And let's say you're fully exhausted on the business side, then you transfer the money or you create a budget for your family, things that cannot be written off on your business return according to the tax code. Then you transfer that money to your family trust so that your family trust always has that money. Your family trust ideally should be showing zero or close to zero in profit on the trust tax return. And then whatever's left over, whatever's in your heart, the good book says give 10% of your income. And so if you want to go ahead and just say, hey, you know what, I'm just going to transfer 10% of my income to my private foundation every year anyway. and let's say you make $100,000 a year, then your private foundation would have $10,000 in the account. That money is not taxed. It's never taxed because it's a nonprofit organization, and that's what you can use to, you can do your charitable work. You can invest that money so that you can have more money to give to the charities. And so, yeah, to answer your question, Robert, basically that 98% trust own, 2% you own structure works perfectly with the strategy as well.
Jeff, I apologize. I think I didn't present that to you correctly. I'm meaning as far as if you have the foreign 98, the 9H foreign trust. If you enroll all of the regular trust underneath that foreign trust entity, that's what I meant.
Got
That
it.
would
Got it.
be
Okay.
tax exempt.
So, yes, indeed. Thank you for that, Robert. For one of the first times in history, I would say that's a better question for Christina. I would say that's a question I would take to Christina offline directly.
Awesome.
Yes, indeed. Thank you for that, Robert. And sorry for the confusion. My lack of understanding behind your question as well. All right. We got 7 minutes to go. Amazing questions so far. Let's go to Kanaya. Kanaya, please go ahead and ask a question. Hopefully I'm saying your name correctly.
Yeah, hi, how are you? I wanted to ask about, I actually consult one of your tax preparer. I'm actually doing my two trusts. I'm a little bit confused when you said about not keeping money in the family trust, meaning whatever was deducted, it should be deducted from the account, right? I'm kind of confused with that part.
Yeah, so basically, a trust is like playing hot potato in that whatever money is left in the trust in terms of profits, right? In terms of a profit, not that money can't be in the account, but in terms of profit, let's say you transferred in $50,000, which is technically income, right? And
Mm-hmm.
then you spent only 45,000. Well, $5,000 that's left over. If you don't transfer that to your private foundation, that $5,000 is going to be taxed at a rate between 10% to 37%. Right. And so what I was saying is that ideally you create a budget for your family. This is things that you cannot write off as a business expense, which is very rare. Things like a mortgage, your medical expenses, stuff that you just absolutely cannot write off directly through the business. And these are things you do have to call out in a trust agreement as well. You just want to make sure that you transfer in the right amount into the family trust, and then that money gets used up to spend on the things that you say that is to be spent on. And in the perfect world, that at the end of the day, that account or that profit should be zero, close to zero, basically.
Oh, every year, right?
Every year,
I'm
exactly.
saying like,
Exactly.
okay, so there's like practically no money left in that account because whatever goes in has to practically comes out.
Correct, exactly. That's right.
Okay, so
That's right.
another question. So if I decide, I actually had a 1099, so I decided to put it under my trust because I'm an independent provider, right? So I use that. But if I want to use like my personal income to, how is it called? To fund the family trust, and I already paid taxes, how does that go? Do you suggest to do that or no? Like
I'm probably not,
I have the red deposit. I have the red deposit, right? So I have several jobs. So I would
for
use
sure.
one of those W-2. Instead of putting in my personal account, I would do the direct deposit to the trust. How does that benefit? What's the pros and cons about that?
Yeah, I would say probably not. When you have W-2 income, it can get a little interesting because technically the only thing that can offset your W-2 income are like assets that are not owned by the trust technically, right?
Mm-hmm.
So like a side business, charitable contribution. Now, one way you could do it is money you donate to your foundation, your private foundation trust. Money you donate there, you can write it off though. You can use your W-2 income. This is what most athletes, for example, would do is they'll take their W-2 income that's heavily taxed and they'll transfer it into their foundation trust. And that way they're not paying taxes, they're paying a small amount of taxes on their foundation trust. And so, I would
Okay.
say maybe for 2025, this is something maybe that we just need to really look at all the details and give you the proper,
Mm-hmm.
layout when it comes to the trust, money movement and
Yeah,
everything.
because Yeah, I need guidance with that because I contact, I think it's Brittany I forgot the person that's preparing my
That's right.
taxes, but I just need guidance how to maneuver the money from one place to the next. I know the part of donating,
For
but I
sure.
just need to learn more with the trust. How could I be able to the deduction, everything else? So I think that's something I would need for, starting this year so I could be able to be better for next year.
Yes, indeed. Yes, indeed. And that's what falls under our tax planning service as well. All right.
Is there any additional pay for that? For the tax
Yeah,
planning,
it
do
is
you
a
have to?
completely different, completely separate service that we offer in the firm.
All right,
That's
but
right.
thank you so much for your help. I really appreciate it.
No problem. No problem, Kania. Most definitely. All right. So we got 3 minutes to go, and I know we have a load of questions in here. And I appreciate everybody's questions, contributions. Let's go to Stacy. Let's maybe Stacy get the last question, and then we'll go in the chat and see what we can answer in 1 minute. Stacy, please go ahead.
Hi, Jeff. Thank you so much. Question for you about the business trust when it owns your LLCs. So if we have two LLCs, my husband owns one, I own one, we were thinking that the business trust would own both of those LLCs. But does it get complicated if he owns one and I own one and we're both filing things that ladder up to that one particular business trust and now we're filing the 1041? Do we need to separate those LLCs into two different business trusts, do you think, as far as tax purposes, or is it not too complicated for us to still file taxes under that one business trust, even though we're both, own a LLC within it?
Yeah, great question, Stacy. So amazing question. My advice is separate it out, right? You have your own, he has his own. Um, but it also depends if you're in a community property state versus a non-community property state. By the way, I'm not an attorney. Anything I say today should not even remotely be construed as, legal advice. But I know a thing or two when it comes to asset protection, all that good stuff. So I would say separate it out. That would be my advice typically with that.
Okay, and really quickly too, we had, the last time you spoke on the Augusta rule, and just a quick question. We had our CPA tell us that they wouldn't recommend filing that because if it's not more than $16,000, then it's something we don't need to file at all. Does that make sense? Because we were thinking that it was a tax write-off, but then it's
Right.
like, well, you don't have to file anything for that.
Yeah, it sounds like the CPA may not fully understand what's going on with the Augusta rule. Because that's a tax deduction. So ideally, yeah, we want to maximize all the deductions possible when it comes to the taxes.
Okay, perfect. Yeah, we'll be calling you. Thank you.
Sounds good. Yes, indeed. Thank you for that, Stacy. Man, this is amazing question so far. And I always hate it when we run out of time, but I know time is limited. I know that, we have other places to be. My Boston Celtics are playing right now. And so with that being said, I do want to pass it back to Christina. Definitely appreciate everybody's time today. Appreciate the questions. I'm hoping and praying we can maybe do another segment where we just strictly go through all the questions. I know we had a lot of stuff in the chat. I would love to do a more formal Q&A where we spend a full hour, right, just doing pure questions. But nonetheless, feel free to click that link. There's no obligations, nothing to lose. Click that link, get the consultations, get the information that you need so that you can make the right decisions and ultimately do this correctly, do this more sound. So let me pass it back to Christina. Thank you everybody for joining tonight. And thank you, Christina, for an invitation tonight. It was amazing.
Thank you so much, Jeff. I appreciate you being here and you giving your time and your energy and your expertise to the community. I know that everyone on this call highly is very grateful for you coming on and just showing us, exactly what we need to do and what type of deductions we can get with the trust. So like Jeff said, go ahead and click on that link. It's a questionnaire, and that's going to put you in connection with him and his team. Inside of the questionnaire, they're going to ask you who referred. Please let them know that you were referred by 7 Ways to Wealth and Christina Yvette, because then they're going to know that you are specifically there, that you have a trust, basically, that you have a trust and that you are going to be needing assistance with your trust. Okay, so with that being said, we are going to invite Jeff back for our for a Q&A session So if you have anything, if you have any questions, either click on his link and go and book that consultation, or hold your questions for the next session if you're not ready. So those of you guys who created your trust this year, you're not going to file taxes. You're going to file taxes next year, but I highly recommend that you get into tax planning so that you know how to maximize your trust this year so that you can reap those rewards for next year, okay? So those of you guys who have been with us since January and you're just now setting up your trust, you don't have to worry about meeting that April 15th deadline, okay? So with that being said, we're going to wrap up the call. Thank you so much to Jeff and everyone, all of the trustee community members that came on today. We love you so much, and we will see you next week for our next masterclass. Have a wonderful weekend, everybody.
Absolutely. Thank you all. Thank you, Christina. See you
Thank
all.
you.
Thank you,
Bye for
everyone.
now.
Bye.
Thank
Thank
you,
you.
everyone. Bye.